thank you all for joining us today. Working through some technical details to get everything rolling, but we're really glad to be giving this presentation, and thank everyone for taking the time out today to join us. As you know, I'm Kyle Burns with the Raccoon Group, and today we're continuing what we're dubbing our trip around the world, where we zoom into specific regions around the world and bring in outside what we'll call sort of specialists or experts. We always experts is a superlative we try to avoid a little bit, but I think we can call Vlad an expert on the region. So we try to bring in experts, and last time we did China, and today we're going to dive in a little bit extra into Europe and the Ukraine, and maybe even some neighboring regions as well, if we have time today. So we really want to thank Payden and Rygel, who helped us out with this, and quickly I'll pass it over to Matt, who's joining us to introduce his team and the group, and then we'll get going with the presentation.
Awesome. Thank you, Kyle. Appreciate for you having us both here, and it's a pleasure to meet everybody. So my name is Matt Riopel. I work with Payden and Rygel. We're an institutional fixed income equity and fixed income manager based out of Los Angeles, with 4 offices located across the globe, and managing roughly around 140 billion in assets under management. And had the pleasure to work with Kyle and the team here for some time, and for having them allocate some funds here towards us. But the main attraction, I guess, of today's call is going to be my counterpart and colleague, Vlad, who is sitting in our Los Angeles office. He is part of our emerging market team, and has been an integral member for, I want to say, 15, 20 plus years. I don't want to steal any thunder from him, but as Kyle was mentioning, we will take a deep dive and kind of on the European marketplaces, especially Eastern Europe. And after Vlad's intro, you'll kind of understand why that he is probably the expert. I guess we can use that term for it. So with that, I will turn it over to Vlad.
Excellent. Well, thank you, Matt.
Thank you, Matt, and thanks for having us. I hope I live up to all the hype. I really do. Hopefully, over the next 20 or so minutes, I'll take you on a little journey around Central and Eastern Europe. We'll focus a bit on Ukraine. We'll set the stage first a little bit with our thoughts more broadly on macroeconomics and what's been kind of the big stories that are affecting this region. And then, of course, at the end, we'll be happy to take some questions about this region and about what's been going on there. And to kick us off, I'm going to share some slides that help us illustrate some of the points we'll be talking about. Hopefully, those are visible to everybody, and we can kick off. Okay, so starting up, what you're seeing is just a bit of a broad outline of where growth has been and is headed for the world. That's a very kind of a broad global summary, and obviously we'll be focused on emerging markets for this conversation, and specifically for Europe. But I wanted to kick off and kind of speak to some of the broader markets and broader countries as well, and really kind of taking a step back. Obviously, 2020 was a very challenging year for growth for obvious reasons. The pandemic happened, and so activity across the globe was restricted in a variety of ways. Different countries obviously did it somewhat differently, but ultimately there was a significant recession that was followed in 2021 by a very nice bounce back in economic activity. So the numbers you see for 2021 are numbers that are obviously very strong, but you have to look at them as a somewhat of a statistical bounce back from a very challenging 2020. A little bit more normalization in 22. You're seeing those numbers generally come down a little bit, and perhaps the one area that did suffer somewhat more from a growth perspective was emerging Europe, where the Russia's war in Ukraine obviously caused a significant disruption in a variety of ways, economically and otherwise. And so that region was affected by that. Going into 23, though, a couple of observations on that. One is that as far as advanced economies go, so the US and the Eurozone, we are seeing or expecting a slowdown in growth. And I think the debate here is going to really focus on to what degree are those economies going to be slowing down? What degree are we going to see a recession? Odds are quite high. Certainly in the U.S., that we are as we head into the second half of the year, we are going to experience a recession. But the question again is to what degree that's going to. Are we going to have a less pronounced or more pronounced type of a slowdown? Interestingly, though, at the same time as that's happening in China, where we went through 2 years of very significant restrictions on economic activity. There was a very abrupt reopening of the economy earlier this year. And so we are seeing significant improvement in expectations for growth there. And so that is one of the things that I think is going to be defining the narrative for this year. And when you think of growth, we think of what's the story as far as economic growth is concerned. And really, in this case, we think that the Chinese growth momentum is going to be pretty significant, and growth numbers there are going to be quite strong. And that has implications, obviously, for the rest of the global economy and for Central and Eastern Europe as well. Moving on to the next slide, in monetary policy, that's the other big story, right? Inflation has been what has been on our minds, on our central banks' minds. The ECB today, Fed yesterday, hiking rates. Those, and obviously having hiked rates for a number of meetings now. Those have been kind of a defining narratives of the last couple of years. Inflation has been obviously quite above target, not just in developed markets, but in emerging markets as well. And so central banks around the world have been fighting against it and pushing policy rates higher in order to cool inflation off. Interestingly, though, if you look at the kind of how those cycles of central bank monetary policies have developed, in the developed market side, you could argue there is a little bit more room for potential further hikes. Now, again, a lot of it depends on future incoming data and where things are headed, for example, with regional banks in the US. So maybe the Fed pauses here for some time and kind of rethinks what they're doing before committing to their next move. The ECB perhaps having a couple more hikes in the pipeline. In terms of on the emerging market side, things are actually quite a bit more advanced in terms of the interest rate hikes. And so what we're seeing there is, even though inflation, especially in the Central and Eastern European region, which is the area of focus for today, even though that remains high and will likely remain above targets for this year, and until it starts to really converge towards targets next year, potentially, central banks are likely done with their interest rate hikes in the majority of those countries, and are starting to contemplate what the next move is going to be, which in some cases is going to be remaining on hold for a while. In some cases, likely going to be actually cutting rates down the line, not immediately, but down the line. So there's a little bit of a timing consideration to think about. And one way to think about this is what I have on the next slide is focusing again on Central Eastern Europe, and it's really showing you the main policy rates for the euro area. So that's the ECB deposit rate. And then for the largest economies in that region, how the monetary policy has evolved in those 4 countries over time. And something that immediately jumps out, I think, from the chart is that those 4 economies and their central banks started to see policy rates move higher immediately or much sooner than the European Central Bank started to increase policy rates. And the reason why that's important is if you take a step back and think about the history of monetary policy in emerging markets, there's a couple of we can spend a lot of time on this, but one thing that I think is quite interesting, it has happened in the past, but happened differently this time around, is typically those central banks lacked credibility and didn't have the ability to initiate their own hikes ahead of the Fed or the ECB more recently. Over time, that has changed, and I'm talking over the last couple of decades. We've seen that credibility increase very significantly. And so this time around, in this cycle of monetary policy hikes, we saw all of these banks start their own hiking cycles well ahead of the ECB. In some cases, as you can see again on the chart, a good year ahead of when the ECB started to hike rates. And so as a result, they were also able to be to complete and start contemplating the end of their hiking cycles much sooner. So we take that as a positive in terms of the ability to conduct independent monetary policy and to be credible as a central bank. And again, obviously, some of those countries were facing a larger inflation issue, so it was justified for them to start hiking policy sooner and by more than what the ECB was doing. Now, this all ties to inflation, right? And where are we on inflation? Again, inflation has been obviously the big topic that we've focused on. One of the big topics we focused on macroeconomically. And so in virtually all of the cases you're seeing on the screen, with the exception of Hungary, we are expecting inflation this year in 2023 to be lower than it was last year. And just to caveat, I should have mentioned earlier, when you see these forecast numbers, the majority of those are coming from the IMF. So third-party objective source, if you will. So inflation is likely to be to have peaked and to start declining in all these countries to varying degrees. Now, is it going back to what are the targets? Likely not. There's still some underlying strength. There's still some components of inflation, like core, for example, which strips out some of the more volatile components. That is actually still in a number of countries quite strong. And so that to us speaks to an underlying strength of inflation, which means it's going to likely continue to be elevated for some time. Very difficult to say when it eventually will go back towards target, but we think the movement, the direction is headed towards lower, not higher inflation. And the reason why we have that view and we think that's the case has to do with the next slide, which is really two slides or two graphs in one. On the left-hand side of the slide, you have the UN Food and Agricultural World Food Price Index. And that's just an aggregate of food and agricultural prices globally. On the right-hand side, you have the Dutch natural gas futures contract price. Those two components, one on the left-hand side is the proxy for food prices. On the right-hand side is a proxy for gas prices, in Europe particularly. The left one is global. So what does that tell us? I mean, it tells us that between the kind of early 2020 and 2022, we've had a lot of pressure on food prices to go up. And that had to do with a variety of different reasons. Obviously, part of it is supply chains and the pandemic and causing a disruption in what was normal food supply relationships. Some of it had to do with the war in Russia and Ukraine and the ability of Ukraine to export grains. Ultimately, all of that conspired to push headline inflation higher because food prices were higher. The second component is energy, obviously, and gas prices in particular have shown to be in Europe particularly volatile. You can see, if you look at the chart, where that volatility started to increase significantly. That was in the buildup to the conflict. If you remember, we first started to see those headlines about troops accumulating around the Ukraine border roughly in the fall of the year prior, 2021. And then those started to become more alarming and more alarming, and obviously leading up to the invasion in the spring of 22. Gas prices, you can almost trace how they started to really, first of all, increase, but also became much more volatile in that period, kind of peaking in the summer in August of 22. And at the time, again, to kind of take a step back and look at the recent history at the time, the concern was really what's going to happen in the winter, right? If you're here in Europe and you receive quite a bit of natural gas from Russia normally, what happens once the winter comes and that supply may be under some degree of threat, perhaps. I was in Europe at the time on a research trip visiting Poland, Hungary, and the Czech Republic. That was late September, early October. And what was interesting is to discuss those kinds of topics with policymakers. And one of the things that really became obvious to me is that they weren't as worried about this as I was, perhaps. And the reason for that is they're already anticipating a decreased demand in energy, which makes a pretty big difference as far as your energy balance. And in retrospect, they all were able to achieve something to the degree of 20 to 25%, give or take, reduction in demand for energy in their countries. But the second component, which partially had to do with luck at the end of the day, was the fact that the weather in Europe that winter was better. Temperatures on average were higher than the average winter. And so there wasn't just as much demand for energy or heating, period. So whether it was, the moral suasion or public buildings being forced to keep the thermostat at 68 degrees, or whether it was, people just voluntarily choosing to use this, or whether it was the fact that they didn't need as much energy because temperatures were higher than usual, all of that combined to reduce demand. And that really helped rebalance the market. And you see the natural gas prices have collapsed back towards the level from right before we started worrying about this conflict. Now, those prices are still higher than they used to be on average. So there is definitely an additional component of higher energy price, but they're nowhere near the price of what we were seeing in those really kind of peaks of price increases for natural gas, because that would have been obviously very problematic for consumers and for industry in those countries. And obviously, natural gas isn't the only thing. Every country uses a mix of different sources of energy, some of them coal, some of them nuclear, obviously gas, renewable, etc. So it's a mix for each country, but it is an important component. And if you look at oil prices, again, you see a similar kind of dynamic where oil prices peaked and have been on a declining trajectory as well, with a lot of volatility along the way. But we are near the 1-year low in oil prices at the moment as well. So all of these things are helping keep headline inflation, food, the pressure from food prices, the pressure for energy prices coming down. That's keeping helping push headline inflation lower. Now, I should say though, as far as continuing down the line of implications for this, there's definitely fiscal implications for energy prices, I should say, and there were fiscal implications of the pandemic prior. So what we're showing on this chart is the fiscal balances for the Euro area, the Central and Eastern European countries, as well as the 4 selected countries I've been highlighting throughout the presentation. And again, that's just the budget shortfall for each year in each one of those countries and regions. And what you're noticing right away is that in 2020, the deficits were really high. They'll range between, call it 7 and almost 10%. Those are really high numbers. As bond people, we don't like to see those numbers, especially on a consistent basis, because those are numbers that need to be financed. And eventually they accumulate as debt, as sovereign debt. And so we understand appreciate the need for that spending to happen in a year like 2020, when you had significant needs due to the pandemic. You had more spending for a variety of reasons, obviously on medical care, on social, unemployment, et cetera, at the same time as your revenues were shrinking because people who were either out of work or for other reasons. So he had almost a double whammy on budgets. But what we do want to see is a credible improvement from that point in terms of what we call budget consolidation. So improvement of numbers. And we have, for the most part, seen that, again, with some exceptions. Obviously, the year after, virtually every country in that space saw a smaller deficit, which is good. And then following that, we've seen some countries continue to consolidate. Others have, for idiosyncratic reason, actually ended up with higher budget deficits. And so as far as expectations for this year go, we're seeing some countries, with a bit of a higher deficit, some with a bit lower. So it's a mix of countries. Next year, we hopefully will see consolidation across the board. So you see all countries in that space, actually end up with a lower deficit. Now, one of the reasons I mentioned why we care about deficit is public debt and what those numbers are looking like. And there we go. And there it is. So public debt to GDP, that is just a measure of how much accumulated debt there is in the economy. So in this case, we're looking at the public side of the balance sheet. So that's just what the government owns. And one of the things that was interesting is, even though we have seen that fiscal part of the equation worsen in some cases, and we're certainly not in a place where countries are creating surpluses, as you saw in the prior page. It's all a deficit, just a matter of how big of a deficit it is. We are definitely seeing a positive impact from nominal GDP. So that's the good news, is that you are seeing an improvement in nominal GDP levels because of the fact that inflation has helped the nominal GDP level of those countries. And so when you look at the ratio of the debt to that GDP number, that number naturally gets flattered by the fact that you have a larger economy. And so we are at a place where, even though spending hasn't exactly been great, we are at a place where debt levels aren't that concerning. And again, as debt investors, we do worry about that quite a bit. They look, for the Central and Eastern European region particularly, they look okay versus the Euro area, which obviously has larger debt levels. And in individual countries, perhaps with the exception of Hungary, which has higher debt levels on average, the rest actually look quite reasonable from an absolute debt accumulation point of view. And of course, we look at a variety of other different factors on this, but I think that's an important one to note, that we haven't had as concerning of a debt accumulation as perhaps we might have or could have, given the conditions we had post-pandemic. Okay, external side, that's a really interesting, and I'll actually finish up on the macroeconomic side with external. So again, going back to the pandemic, it had a mixed impact, because obviously, if you think about the supply chain issues that countries were facing, that has an implication for a country's exports. So the ability to continue to export, if you're, let's say, a car manufacturer, and you need a part to come from another country, or multiple parts. Typically, if you look at a car, it's a complicated machine, and the parts coming from different countries all the time. Well, if a few of those are missing, you can't quickly turn around and really create those on the fly. So you're really in a tough situation as far as your ability to put out the final product and export that. So exports did react to that, but also so did tourism and travel. So we did have a kind of a mix of impacts on the external side and the demand for dollars. Fast forwarding to last year, and then the energy situation in Europe, I mean, that was a pretty definitively a negative impact on the external side. As you know, as a country imports energy, all of these countries to a large degree are energy importers. Some of them have domestic sources. Poland has coal, and Romania has gas, but they're all importing additional energy to their economies. And so if that energy price goes up, then all of a sudden, of course, you're paying for more for the same amount of energy as before. And so that impacts your balance of payments and your current account balances. And so almost uniformly, if you look at comparing 21 to 22 on the chart, you see that the external balances became much larger. And again, the reason why we focus on that and worry about that is that those need to be financed. You need dollars or euros in order to pay for those. And if you don't have those, you don't have a source of those, then that becomes an issue for the economy over time. Now, the good news this year, like we saw before, energy prices are a lot less problematic and a lot less high. And so what that means is that from a perspective of external balances and accounts, this year should be significantly better than last year, all else being equal. So that's a positive. That's a positive for those economies. I also included one final slide on markets, because I felt that maybe that will be a nice way to kind of think about the regions as well, as without delving into the bond side or any strategy side, just kind of looking at currency. So what I have on the screen are two sets of currency charts. One is just, again, focusing on those four countries we've been focusing on, so Poland, Czech Republic, or Czechia, Hungary, and Romania. And then on the right-hand side of the page, we have a more expanded set of currencies. And those are going to be, broader. What's the difference? I am getting a message and my screen sharing is paused. I'm not sure why, but hopefully you can still see the screen.
We're still good right now, Vlad, as far as I can tell. So
awesome, thank you. All right, so just to go over those two charts, then on the first side, on the left-hand side, you do have those more traditional or larger EMs, and for them we did have a weakness into the first part of last year, understandable given what was happening in the region. There was a lot of concerns about investing in this region and what would happen in case the conflict escalates. Those concerns were somewhat relieved towards the latter part of the year, and we started to see somewhat of a reversal of performance for that period. Whereas on the right-hand side of the page, you're seeing a much more, I think, interesting set of movements. And that's partially because some of the currencies on the right-hand side of the page have a different way of operating. They're not free-floating like the ones on the left, with one caveat: Czech Republic's currency sees some intervention, but for the most part, they're free-floating. Right-hand side of the page, you do have some currencies that are roughly pegged, like the Uzbekistani Sum, for example, and Ukraine, the hryvnia, which used to be free-floating, has more recently, after the conflict started, being pegged, revalued, and pegged again, and so it's sort of a straight line. It doesn't move around, as you can see, all that much. That's being done for obvious reasons in that case. And the last one I'll highlight, obviously, the one that you're seeing the most volatility. So that's the blue line. It goes all the way up and then somewhat all the way down, and then sort of starts to move sideways to kind of upward. That was Russian ruble. And so I think that's a good counter argument if you hear the statement or perhaps the opinion that sanctions haven't really worked on the Russian economy. You can kind of look at the movement in the Russian ruble to see how actually it has reacted to those sanctions, selling off significantly in the beginning, strengthening afterwards, but then once again selling off, and the strengthening really was driven by the central bank measures there, but then naturally continuing to weaken over time. Okay, now I think this is a nice segue into speaking to Ukraine, or the last thing I'm going to speak to today, and that is on our last slide of our presentation. So, I mean, before I even touch the macroeconomic or financial impact of what's happening, I think that there is a just enormous humanitarian toll to the conflict that's now a year plus old. And it's very difficult, if impossible, to measure. What we can measure is the macroeconomic side, and that is has been rather obviously devastating as well. Looking at GDP, for example, the economy shrunk by 30% last year. That is obviously not going to repeat this year. We are going to see a bounce back, but no significant growth. Maybe a very small growth. We'll see. Depends on where the rest of the year goes. On the external side, interestingly, things have actually looked quite good considering the circumstances. And so whether you look at the current account, whether you look at foreign reserve adequacy, which is a measure we look at to see how much dollars is available to pay for a country's imports. So if we have more than 3 months for imports, that's typically seen as the minimum that you don't want countries to go under. And Ukraine has stayed quite nicely above that. A big reason for that is obviously the fact that there's been massive amounts of international support going to the country, whether that's the United States support, whether it's the European Union, whether it's individual countries that have contributed. And more recently, we had the International Monetary Fund last month actually complete a negotiation over a new program, 16 billion plus program for Ukraine. And to my knowledge, that actually is the first time the IMF has lent to a country in an active conflict. So it's a really interesting first for the country. But all of these things have helped to preserve the external stability and reserves for that economy. And last, and this is more of a qualitative comment than anything else, but it's actually remarkable to see how well the authorities in Ukraine have managed to run the economy at a time when, again, it's a wartime economy, but the banking system didn't crumble, ATMs work. It's actually, the economy has continued to function even in a very obviously challenged state and a challenged environment. So they've done a pretty superb job of actually running that economy. So I think I've spoken too much. So I will stop here and I'll be happy to take any questions.
Great. If we go ahead, let's go ahead and stop the screen share and we can dive into the Q&A portion. Great. Thank you for all the background economic information. It's really helpful to sort of set the tone of some of this conversation. And for anyone on the call today, please feel free to reach out to us, info@raccoongroup.com. If you have any specific questions you're trying to ask, or you're welcome to email or call any one of the team members here in the office with your questions. So maybe if we just start with kind of thinking, so if we take all the data that you've presented a little bit and we think about Central Europe and their economies, Central and Eastern Europe and their economies, is there a general trend? How should we sort of view those economies as a whole in terms of, is it heading towards weakness, or is there still strength in them?
Yeah, I think that's an excellent question. I think that there's a couple of things to think about here. One is this year, economic growth is obviously slowing down in those economies. We are at the tail end of a significant monetary policy type, right? So what we would expect would happen if monetary policy works, and the theories behind it work, is that you'll see a degree of impact from those tightening decisions, and that impact is typically delayed by, call it, 4 to 6 quarters. So if you look back when the policy tightening started, it makes sense to us that you're starting to see a kind of a more pronounced slowdown. We actually started already to see it last year, but into this year. So there's definitely the trend for growth to decline, although not to levels that are concerning to us. It's simply declining versus where it was the year prior. I would say the big perhaps win for this year for the region would be inflation. If we do see continued decline in headline inflation, we think that ingredients are in place for that. Certainly policy has tightened a lot. Like I mentioned, energy and food prices have, the pressure from those has declined certainly. That should really lead us to a better inflation picture, which in turn is going to allow the central banks to start contemplating easing policy policies and reintroducing growth. I think that the other big story to watch for this region is its relationship with the European Union. Some countries have better relationship than others, and that has beyond politics, beyond diplomacy, it has real implications in terms of money, in terms of funding, whether that's from sort of the regular European budget or the additional funding which was put in place after the pandemic. So countries like Romania have done a really good job of really adopting that funding and meeting the conditionalities associated with receiving the funds. Countries like Poland and Hungary, on the other hand, have not done as good of a job and have seen some of their funding access frozen. That's a pretty meaningful portion of external funding for those countries, and so we want to see. Hopefully, they'll put the right policies and procedures and laws in place to unlock financing and to continue getting that financing. But like I said, that performance has been somewhat uneven. So that's something that we watch quite carefully, and it impacts the way we think about those countries from an investment point of view.
Great, thank you. I was wondering, we're here in the U.S. right now, but when we look at these economies, maybe is there something that from the general U.S. perspective that we miss or kind of don't understand about these economies? I certainly think back to when the war in Ukraine started and we didn't understand their contributions to what it be maybe grain production, I think was a big issue, right? And so we never thought about that until it actually occurred.
Yeah.
So are there other areas where we should be thinking about these economies, sort of their contributions globally and how it impacts all of us?
Yeah, I mean, it's interesting you mentioned that because there's definitely some when we don't think of supply chains until they break, right? At least most people don't. I guess if you're involved in manufacturing, you do think about it, but most people are not going to be focusing on where all the components in their iPhone or iPad, which come from however many countries in the world, until that's not working. So there's definitely I think that there's definitely a lesson to be learned about how truly global the economy is, and how events in one part of the world can really impact the rest of the world quite significantly. I would say probably the biggest impact was through energy prices and energy inflation, energy-driven inflation. That's certainly something that I think markets should be more cognizant of. In terms of the rest of it, I mean, the other part I think has to do with security, really, and the fact that we are a little bit more removed from what's happening. But if you're sitting in Poland or Romania, you're next door to Ukraine and to what's happening in the conflict there. So there's definitely a renewed, I would say, I think, appreciation for the role that something like an institution like NATO plays in those countries. The fact that they're members of NATO and are being provided additional security, the fact that they themselves need to spend more on security, on their own security, that's I think again a relatively not new, but I think there's a renewed focus on the fact that there is an active conflict next door, and that causes reprioritization of fiscal spending and investment for obvious reasons. So I'll kind of highlight those two things, but I'm sure I'm missing stuff. I mean, there's definitely a lot of these impacts are not immediately obvious, but then 6 or 12 months down the line, you realize that it's one component in a car that comes from a specific country that if you don't have it, then you can't build a car. So that's something that I think we all learned to appreciate a little bit more in the last 2 years.
And then I think I was kind of wondering, when I was trying to look back at my question. Sorry here. Yeah, I mean, what were some of the factors when I was looking at the chart and looking at kind of Poland and Hungary and their real high inflation numbers? Were there factors that led to that, and does that create sort of bleed over into other countries of the region or even into the Eurozone?
So, as far as the Eurozone is concerned, probably not. I would say that there is definitely a there's multiple idiosyncratic reasons why we're seeing inflation at these levels in those specific countries. There is definite stickiness of core inflation there, having to do with labor markets and wage growth. There's obviously implications of fiscal policy, domestic fiscal policy. There were some, if you're in the case of Poland, for example, you received a lot of refugees, especially early on in the conflict, that were displaced from Ukraine. That probably boosted the demand for certain goods and services initially, so that might have had some marginal impact. So it's a variety of things that would drive. So not necessarily in the sense of spilling over outside of those countries, but ultimately the inflation picture looked very similar, at least from a trend perspective, in the region. It's just that they were seeing somewhat elevated levels. But they did the right things. I think that's the ultimate, for the most part, the ultimate lesson is that you did see central banks hike. Poland's case perhaps may have done, it could have hiked a bit more, and perhaps stopped too early. Concerns about growth. You can argue, or we'll argue in retrospect whether that was the right decision or not. But I do think that there's definitely a component of the response to inflation which was encouraging, as central banks did the right thing, and hiked policy quite dramatically over the last year and a half or so.
So when we look at the conflict in Ukraine and, beyond, as you mentioned, certainly the humanitarian toll that it's taken on, on the citizens, but thinking, I think it's already lasted longer than the majority of the public thought it was going to last when it started, and it doesn't look like it's slowing. So what does that extended conflict look economically, whether it be for Ukraine or the rest of Europe?
Yeah, and we're not military experts. We talked to some, and so we unfortunately have no great visibility as to how long things might continue, because that does have implications on the economic side of things. But as the best and brightest minds we speak to, think that this is likely headed in the direction of a frozen conflict, or some sort of a stalemate where either side is able to advance in a meaningful manner. And so what you're seeing in terms of a map of the conflict now will more or less remain fairly stable. Obviously, we do have Ukrainian offensive potentially coming up, so we'll see what that leads to. But ultimately, it seems like both sides are retrenched for the most part where they are, and so if that's the case, then you have to start thinking about reconstruction down the line, and once the hostilities hopefully end, or at least lessen to a point where you can start thinking beyond the immediate aftermath of the conflict, and looking ahead in terms of infrastructure development. And those needs are massive, and will continue to increase. We've seen a variety of different estimates. I don't think any estimates really at this stage are
worth speculating on.
Yeah, but we're talking about hundreds of billions of dollars. I think that's we can safely say that. And once that happens, I think that there is a lot of goodwill and a lot of investment dollars that are going to be looking to return to Ukraine, but that's unlikely to happen until things have quieted down in terms of the actual fighting. So that's the unfortunate uncertainty there, is that a ton of goodwill in the international community and a ton of good ideas as to how to help, but the situation has to stabilize first in order to do that. Otherwise, the country has a ton of potential, always has. And so with the right policies, the right people in place, and some peace dividend, that it can definitely thrive.
Mm-hmm. So we know that, I believe you just came back from Turkey.
Yes.
Maybe you were visiting other areas in the region, and hopefully you've recovered from your jet lag at this point. But what were some of the things maybe you learned from your recent trip to Turkey and other areas in the region?
Yeah, it ended up being just Turkey this time from a research perspective, and really a really interesting visit within a country that has an election coming up next Sunday. So really down to the line here, where you have a pretty stark choice to make as a voter in Turkey between keeping the current government and president and choosing a change of those and in different direction for the country and the economy. From a macroeconomic perspective, that has been a very challenged story for us with a very unorthodox policy setup. And what we mean by that is that the central bank, instead of doing what we were looking at earlier, the hiking rates when inflation went up, they actually ended up easing rates into that, and inflation became an ever-growing issue in the country last year. This year it has declined, but it's still quite so much higher than where it should be or can be. So that has been an area where potential electoral victory to the opposition would restore orthodox policymaking, and in other words, letting the central bank do what it should, not what it's being told to do for political reasons. Of course, there is a lot of power in incumbency, and the current government and president and party have been in charge for better part of 2 decades. So it will be difficult for the opposition to make significant inroads. But if polls are correct, and we take this as a big grain of salt, because polls in developed and emerging markets have been incorrect in recent years for a variety of reasons. But if polls are correct, and we did meet with multiple different polling agencies on our trip to Ankara and Istanbul, it seems like the opposition does have a good shot of winning. Whether that actually happens or not, we'll have to wait and see for May 14th and May 28th if the second round of presidential elections is needed. But we do think that if they do win, and the people we met and spoke to, who may ultimately be key people in the economic team and the finance team, are very credible and have the right ideas in mind. Whether they get a chance to implement those or not, that's what we have to wait and see. But we do think there's potential there for an improvement. It's just that, of course, volatility will likely rule in the short term, and you do have to see where the election goes.
Great. So maybe as we kind of move into the tail end of the presentation here, maybe we could just talk about, like, how should we view investing, whether it be in the Eurozone or in sort of the emerging economies of Europe? How really should we be looking at that as an investment opportunity?
Well, I think that for us, it's a matter of, and that's just giving a bit of a window as to how we look at them. First of all, each country in this space, in the emerging market space, that we are involved with is subject to the same framework of analysis that we perform. We look at a lot of the stuff that I just showed you. We look at growth and inflation and interest rates and external balances and ESG factors for all of those in order to be able to assess what the trajectory of that country is, whether it's improving, deteriorating, or perhaps not changing all that much in the next, our horizon is 6 months. And so when we do that in relation to whether the different investment opportunities within that country, whether it's local bonds, whether it's euro bonds, whether it's currency, whether it's all of the above. So the assessment ultimately seeks to generate an expectation of total return for each one of those countries and markets, and that allows us to compare and to take a look at what those markets are going to be delivering, or we think they'll deliver, versus some of the rest of the emerging market space. Because we don't have just Europe, we look at LATAM and we look at Asia and Africa, Middle East, etc. And so the result of that assessment isn't necessarily a regional one. So it's not as much about a regional bias, it's more about ultimately which countries emerge as those that we think are going to do the best, which ones we think should be avoided, and sort of everything in between. And so that's how we think about that, the sort of the investment opportunity within that universe. And so it's all placed if you will, in a global context. It's not done in isolation. I will just say sort of bigger picture though, there's definitely, the closer you are to the conflict, the more challenging I think that investment case becomes, not just from a short-term perspective, but also longer term. Because there's obviously, I think, understandable concerns about being in near proximity to what's happening, and whether that's, when you think about longer term type of foreign direct investment, when you think about portfolio flows, those are all considerations that you have to think about. Ironically, countries that were in the neighborhood, and I'm talking about countries like Armenia or Kazakhstan or Uzbekistan, et cetera, they actually ended up receiving a lot of capital and immigration from people leaving Russia last year. So they ended up, receiving quite a lot of investment and remittances into those economies, and that's probably a one-off type of impact, but that was an interesting side effect, if you will, of what happened. But I think longer term, you really have to think about, now, to what degree are you comfortable with that kind of when the region, and be selective? Ultimately, I think it's the right way to approach it, and think about trade linkages, think about political linkages, and how countries position themselves, and in a diplomatic sense, in political sense, and then that should help guide your investment decision to, in almost as much as the macroeconomic side of things, so where you think growth and inflation and interest rates are going.
You spoke to influence, and I know something we've seen a lot of is China's influence in their interactions with Russia. Does China have much influence when it comes to other countries in the region?
I would say it varies, right? If you're looking at the Central European countries, there's, I'll say, less direct influence and less direct investment, but it certainly has an impact on economic activity, because if you think about the Hungarian economy or the Czech economy, they're very integrated with Germany and the Eurozone, right? They have a lot of trade connections, a lot of trade going back and forth of let's say, in car manufacturing. And so if Chinese economy does well, which we think it will this year, and that should help exports, overall, certainly Eurozone exports, and by proxy should also help some of those economies in the region. Now, if you move a little bit further east, there's definitely stronger influence in some cases, like, for example, in a country like Kazakhstan, which is geographically obviously proximate, and also there's more of a more connection there from an economic point of view. So it does vary, but I would say more broadly, China's influence to the world is quite significant from a global growth perspective, from a trade perspective. Emerging markets have been trading more with China versus what we've seen in the past, and so it definitely a stronger Chinese activity profile and growth profile should be beneficial to emerging markets, and that's certainly to that set of countries we've been discussing.
Great, thanks. So maybe to wrap it up here, as we end the presentation, maybe what is, if we think about the region, what is something you're most excited about or optimistic for in the region? Obviously beyond an end to the conflict, but thinking about whether it be a place to invest or, a trend you're seeing. Is there something that just, when you talk to people, you're like, this is really fascinating and exciting for the region?
Yeah, I mean, I'll echo what you just said in terms of, ending the conflict really is number one, and the amount of human suffering it's caused is enormous, and so that definitely is number one on the list. I think what I'm a believer in the European project. I I think that the idea, the concept of the European Union of taking a continent and a set of countries which in the past have spent centuries fighting with each other, actually not so long ago, until not so long ago, and creating an economic and political entity which unites them and emphasizes the commonalities versus the differences, and makes it ultimately impossible to see this happen, this kind of a degree of conflict to happen again. I think that the fact that we are where we are with the EU and the Eurozone and the Euro as a currency of a subset of the EU countries, the Eurozone countries, that is a enormous achievement. And seeing that project extend to the East further, I think is really a key to really sharing that prosperity and sharing that path with the rest of this kind of the Central and Eastern European part of the region. And we've already seen obviously quite a bit of expansion. A lot of the countries we've been talking about today are EU members, but there's no more that aren't and are in the waiting room and in at different stages of conversations, and seeing that continue to expand means a couple of things. Means expanded access to markets and trade, means obviously a lot of additional investment which those countries wouldn't get otherwise. It creates, makes them part of a bigger whole. So you're definitely as a standalone country, you're perhaps too small to really be able to dictate terms in a trade negotiation. But the EU as a whole it's quite a large entity, right? Quite a large economy in population. So there's strength in numbers when those countries are united and able to push towards a stronger goal. And don't get me wrong, I mean, there's definitely individual countries where there's a variety of attitudes towards the EU, some of them negative. There's leaders within the EU that are almost pushing in the opposite direction as we speak. But I think overall, the post-World War II project, which started with a very limited goal, it was the European coal and steel community, and has become what it is today. It has obviously further to evolve, but I think that's a remarkable achievement, and it makes me excited to see the more recent members, recent as of the last 20 years, but also the ones that could be joining in the future, become part of that union, and from an investment opportunity that we obviously appreciate that the fact that there is an investment opportunity there, but more broadly to become part of that political family. I think that's a pretty important thing.
That's really great. Thank you, Vlad, and thank you everyone who had the chance to attend today. We really appreciate this. And we get Matt back. So thank you, Matt, for joining us again and setting everything up. And thank you to Payden Rygel and Vlad. It was really great to have your insights on the call today. And as always, if anyone has follow-up questions from the presentation, please feel free to reach out to anyone on our team, and we can work with Payden to get you those answers as needed. So once again, thank you both. And any parting words, Matt?
No parting words. We truly appreciate you guys allowing us to come on, especially for Vlad as well, to speak about the region. It's always a great opportunity to speak to the end clients as well. So thank you to all who are on board right now.
Great. Thanks again, and we look forward to talking again soon. Thank you.